Hello friends. In this unit we are going to discuss further some of the more financial services, that is your factoring, forfeiting, bill discounting and bills rediscounting. So first of all we will discuss factoring. Factoring means the sale of receivables, that is book debts by a firm, a client to a financial intermediary who is known as factor, who pays when they are collected or in a guaranteed payment date. It basically involves transfer of collection of receivables and related maintenance of records from the client to the factor. In essence, factoring is a source of financing of receivables and facilitates the process of their collection. If we consider the mechanism of the factoring, in this basically we will see, considering the factoring mechanism, we will see that seller, in this case seller does not maintain a collection or credit department with itself. After sale, a copy of the invoice or delivery challan, the agreement or other papers are handed over to the factor. Once the factor receives the payment from the buyer on the due date as agreed, whereby the buyer is reminded of the due date payment amount for collection, the factor remits the money collected to the seller after deducting its own service charges at an agreed rate. Thereafter, seller closes all transactions with the factor. The seller passes on papers to the factor for recovery of the amount. So, this was all about the mechanism of the factoring. If we see the functions of the factoring, depending on the type of factoring, the main functions of factor can be classified into 5 types. Thus, for factoring services, there are major 5 functions, that is maintenance of sales ledger, collection of receivables, financing of trade debts, assumption of credit risk control or protection, and provision of advisory services by the factor institution. Further, factoring can be classified into various forms. On the basis of the features which are built into the factoring, it deals with the catering to the varying needs of the trade or clients. There are different types of factoring. The main classification of factoring arrangements are recourse and non-recourse factoring, based on the assumption of credit risk associated with the collection of the receivables. Another one is advanced maturing and participation factoring, related to the time of payment on the account of receivables by the factor to the client. Third one is full factoring. Fourth is your disclosed and undisclosed factoring, based on the basis of disclosure and non-disclosure of the name of the factor in the invoice. And last one is domestic and export or cross-border or international factoring, based on the domicile of the parties involved. So what are the advantages of factoring? Factoring results in immediate cash flow. Factoring allows businesses to convert their account receivables into immediate cash, providing them with the necessary funds to cover operational expenses, pay suppliers, and invest in growth opportunities. So, factoring, if we see, another advantage of factoring is that no debt is incurred in case of factoring. Since it's not a loan, so there is no debt taken on by the business. The funds received through factoring are simply an advance on money already owed by the customers. Another advantage is that factoring leads to improved working capital. It improves companies' working capital by accelerating the collection of funds that would otherwise be tied up in the unpaid invoices. This can help businesses manage their cash flow more efficiently. Other than it, factoring companies often provide credit checks on customers, reducing the risk of non-payments or defaults by the clients. This can help businesses avoid losses due to bad debts. Further, factoring companies handle the collection process, saving the business time and resources that would otherwise be spent on chasing down late payments. Thus, it is a kind of outsourced collections mechanism. Further, factoring provides flexibility since it can be tailored to the needs of the business. It can be used on an ongoing basis or selectively as and when required, providing flexibility in managing cash flows. Factoring services give access to expertise since the companies giving factoring services have deep understanding of various industries and markets. Therefore, they can provide valuable insights and advices to businesses, helping them make informed decisions. Further, factoring transactions provides a mechanism of fast funding since it can be processed relatively quickly, providing businesses with the rapid access to funds compared to traditional lending options, which may involve lengthy approval processes. Factoring helps businesses to focus on core operations with the financial aspects taken care by the factoring organization or the institution providing factoring services. The businesses can focus more on their core operations, product development, and expansion strategies. In case of factoring, no collateral is required since factoring is based on the credit worthiness of the business customers, not the business itself. This means that businesses do not need to provide collateral to secure funding. Other than it, if we see factoring services results in no prepayment obligation. Since factoring is not a loan, there are no fixed repayment schedules or interest payments. The business simply pays a fee to the factoring company for their services. Further, factoring may help the businesses in scalability since it can easily accommodate a growing business. As sales increase, the amount of funds available through factoring can also increase, helping the business meet higher demand. Further, factoring is often accessible to businesses that might have difficulty obtaining traditional financing due to factors like limited credit history or poor credit scores. Therefore, it factoring basically provides an easier qualification to the businesses. Through factoring services, we can say that businesses can access cash quickly and businesses can take advantage of time sensitive opportunities such as bulk discounts on inventory purchases or marketing campaigns. Further, factoring also allows businesses to maintain control of their business and ownership of their business over their operations while still accessing needed funds, unlike your equity financing. So it's important to note that factoring services offer several advantages, but it may not be suitable for every business. Each business should carefully evaluate their financial situation, cash flow requirements, and terms offered by factoring companies before deciding to pursue this financing option. Then another kind of services, financial services, which we are going to discuss in this unit is forfeiting. Forfeiting is similar to that of factoring. So forfeiting is a form of financing of receivables relating to international trade. It is a non-recourse purchase by a banker or any other financial institutions of receivables arising from the export of goods and services. The exporter surrenders his rights to the forfeiter to receive future payment from the buyer to whom goods have been supplied. Forfeiting is a technique that helps the exporter sell his goods on credit and yet receives the cash well before the due date. In short, forfeiting is a technique by which forfeiter discounts an export bill and pay ready cash to the exporter. The exporter in this case need not bother about collection of the export bill. He can just concentrate on export trade. So, what actually forfeiting means? Forfeiting is a means of financing that enables exporters to receive immediate cash by selling their medium and long term receivables. The amount an importer owes the exporter at a discount through an intermediary. The exporter eliminates risk by making the sale without recourse. It has no liability regarding the importer's possible default on the receivables. So now coming to the benefits of forfeiting or advantages of forfeiting, we can see that forfeiting provides a form of medium to long-term financing, often spanning several years. Thus, it makes it suitable for businesses involved in large international transactions that require extended payment terms. Further, forfeiting helps mitigate the risk of non-payment or default by transferring the credit risk from exporter to the forfeiting institution. This can be especially valuable when the dealing with unfamiliar or politically unstable markets. Forfeiting provides businesses with a fixed and predictable cash flow. Once the forfeiting agreement is established, the exporter receives a fixed amount at a predetermined future date, allowing for better financial planning. Further, forfeiting allows exporters to remove the receivables from their balance sheet, which can improve the financial ratios and creditworthiness of the exporters. In most cases, the forfeiting institutions assume the full credit risk of the transaction. That is, it is your funding is available on no recourse basis to the exporters. This means that if the importer defaults, the exporter is not held liable and still entitled to receive the agreed upon payment by the forfeiting institution. Further, as similar to your factoring, forfeiting provides upfront cash payment to the exporter, freeing up the working capital and enabling them to finance new projects, fulfill other orders, or invest in their businesses. Also, forfeiting transactions can be denominated in a variety of currencies, and the forfeiting institutions typically bears the currency risk. Thus, this shields the exporter from the potential fluctuations in exchange rates and provides the facility of no currency risk. Forfeiting simplifies export finance since it eliminates the need for complex credit insurance guarantees or letters of credit. Further, forfeiting enables global expansion, thus enabling business to explore new international markets without the concerns of payment delays or credit risks, as these are managed by the forfeiting institution. Forfeiting boosts cash flow in developing markets. It is particularly beneficial for the exporters to export to developing countries where credit and payment risk might be higher. It encourages trade with these markets by providing a secure financing option. If we talk of flexibility, then forfeiting can be customized to suit the needs of both the exporter and the importer. Thus, you can enter into a forfeiting agreement on flexible terms, including factors like payment schedule, interest rate, and other terms. Further, forfeiting helps to achieve a competitive advantage by offering extended payment terms through forfeiting and giving exporters a competitive edge by attracting international customers who might be seeking favorable financing options. Further, forfeiting doesn't affect existing banking lines of credit, allowing exporters to maintain their relationship with banks for other financial needs. Forfeiting helps in diversification of funding since it diversifies funding sources for exports, reducing reliance on traditional financing methods and enhancing financial resilience. Forfeiting reduces the administrative burden associated with collections and credit management, allowing businesses to focus more on core operations and growth strategies. Thus, it's important for businesses to carefully assess the terms, cost, and implications of forfeiting before entering into an forfeiting agreement. Since it offers significant benefits, but it's essential to ensure that the forfeiting agreement or this financial services aligns with the business financial goals and strategies of the particular entity. Now, the third financial services which we are going to discuss is bills discounting or discounting of bills. Discounting of bills of exchange is a lucrative fund-based services provided by the finance companies. The act of handing over an endorsed bill of exchange for ready money is called discounting of bills. The margin between the ready money paid and the face value of the bill is called discount rate and is calculated at a rate percentage per annum on the maturity value. The maturity of a bill of exchange is defined as the date on which payment will fall due. Bill discounting emerged as a lucrative fund-based activity in India after the mid-80s. However, it emerged as one of the contributory factors in the securities scams occurred in India during 1990s. As a result, RBI in July 1992 imposed several restrictions on the bill discounting mechanism, reflecting its importance in terms of lesser volume of business in the last couple of years. So, although bill discounting is one of the major financial services, but the volume of businesses in bill discounting have decreased in the last couple of years. So basically, if we talk of advantages of bill discounting or discounting of bill exchange, basically we say that we will find that it offers several advantages to business and individuals looking to manage their cash flows and improve their working capital position. Here are some of the key advantages of bill discounting. First one is your immediate cash flow improvement. Bill discounting allows businesses to receive a significant portion of the invoiced amount upfront, usually within a shorter period. This immediate cash infusion helps improve cash flow, enabling companies to meet operational expenses, invest in growth opportunities, and cover unforeseen costs without waiting for the payment due date. Further, it provides a benefit of enhanced working capital management. By accessing funds from their outstanding invoices, business can optimize their working capital management. This enables them to maintain sufficient liquidity to support day-to-day operations and seize new business prospects. Third benefit we can discuss of is reduced financing cost. Bill discounting can be an effective cost-reducing alternative to traditional loans and credit lines. The discounting rates are often competitive, especially when compared to the interest rate associated with the loans. This can lead to overall savings on financing costs. Further, bill discounting offers flexibility, or we can say it's a flexible financing option that can be tailored to the business needs. Companies can choose with which invoices to discount, how much to discount, and how often to use the services. This adaptability allows businesses to address specific cash flow gaps without committing to long-term financing agreements. Further, there is no additional debt in case of bills discounting, since unlike loans that adds to a company debt load, bill discounting is not considered a loan. It involves the sale of an asset, rather your invoice, rather than borrowing, which means it doesn't appear as a liability on the company's balance sheet. Further, bill discounting helps in credit risk mitigation. When working with a reputable bill discounting provider, business can benefit from credit risk mitigation services. The discounting company often assesses the creditworthiness of the debtor and takes on the responsibility of collecting the payment. This can protect the business from bad debts and administrative hassle of chasing payments. It allows businesses to focus on core operations. Outsourcing the invoice collection and payment management allows businesses to focus on their core operations and strategic activities. This can lead to improved productivity and efficiency of the businesses. Further, bill discounting offers scalability. As business grows, its financing needs may change. Bill discounting can scale along with the business growth, making it suitable for both small and large enterprises. Further, further, bill discounting is a quick and simple process in which a business establishes a relationship with discounting provider. Subsequent transactions can be completed quickly, providing rapid access to funds. Further, bill discounting also provides access to the businesses for expertise from the institutions providing services of bill discounting. Thus, some bill discounting providers offer additional services such as credit assessment, data management, and financial advice. This expertise can prove valuable for businesses looking into optimize their financial operations. In conclusion, bill discounting offers a range of advantages, and every business can leverage this bill discounting services to enhance their financial stability, seize growth opportunities, and efficiently manage their receivables. Further, the last services, financial services, which we are going to discuss is bills rediscounting or rediscounting of bills. So what is rediscounting of bills? Rediscounting of bills is a financial practice that involves discounting of negotiable instruments, typically short-term promissory notes, bills of exchange, or government securities by a financial institution. A rediscount occurs when a short-term negotiable instrument is discounted for a second time. This process allows the original holder of these instruments to obtain funds from a third party, usually a central bank or another financial institution, before the instrument's maturity dates. Rediscounting serves as a means for financial institutions to manage their liquidity and obtain quick access to funds. So how your bill rediscounting works? One first thing is that first step in rediscounting of bills is original discounting. A borrower, usually a business or individual, borrows money by issuing negotiable instruments such as promissory notes or bills of exchange. These instruments represent a promise to pay a specific amount at a future date. Further, these borrowers go for initial discounting. The borrower or the businesses or individual may take these negotiable instruments to a financial institution such as bank for discounting. These financial institutions evaluate the creditworthiness of the borrower and the quality of the instruments. If approved, the institution provides the borrower with a discounted amount which is lower than the face value of the instruments. The financial institution then holds the instruments until their maturity, at which point it collects the full payment from the client. Further, rediscounting is done in some cases. These financial institutions who are providing initial discounting may need to access funds before the instrument's maturity. In that case, they take the instruments to the central bank or another financial institution for rediscounting purpose. The central bank or institution provides funds to the financial institutions based on the face value of the instruments minus a discount. Thus, in this manner, how your bill discounting process works out. So, further discussing the advantages of bill rediscounting. First advantage that rediscounting of bills provide is liquidity management. Since rediscounting of bills provides financial institutions a way to manage their liquidity needs in case of requirement of funds, they can quickly obtain funds by rediscounting instruments, especially when faced with short-term liquidity shortages. Further, with the help of rediscounting of bills, financial institutions can access to central bank funds. Commercial banks often rediscount instruments at a central bank. This allows them to access funds directly from the central bank reserves, enhancing their liquidity and supporting stable financial operations. It provides flexibility in terms of financing since it offers flexibility to financial institutions in terms of obtaining short-term financing without the need for complex arrangements. Further, rediscounting of bills leads to economic stimulus since central bank can use rediscounting to inject liquidity into the banking system during times of economic slowdown or financial crisis. Thus, this can help stimulate lending and economic activity in the country. Further, another benefit of rediscounting of bills is risk mitigation. This practice of rediscounting of bills enables financial institutions to reduce risk by diversifying their sources of funding and maintaining smoother cash flow. So, in this unit, this was all about your factoring services, forfeiting services, discounting of bills, and rediscounting of bills. Thank you.